Most beginners think trading starts with predicting whether price will go up or down. It does not. Trading starts with understanding the market you are in, the instrument you are using, how that instrument moves, what it costs to trade it, and what could go wrong if you size the trade incorrectly. This chapter is the foundation. Before entries, indicators, strategies, or funded accounts, you need to understand the basic language of the market. Trading is the act of exchanging one asset for another with the goal of benefiting from a price change. If you buy, you're expecting price to move higher after your entry. If you sell short, you're expecting price to move lower after your entry. That sounds simple, but the important part is this. Every trade is a decision made under uncertainty. You never know the next move. You manage the risk of being wrong. A market is basically an auction. Buyers are trying to buy at the best price they can get. Sellers are trying to sell at the best price they can get. When both sides agree, a transaction happens. That transaction becomes part of the chart. So a chart is not magic. It is a record of decisions. It shows where buyers were willing to pay, where sellers were willing to accept, and where price had to move to find the next trade. Most retail traders focus on a few major market categories. Forex is currency trading. Stock indexes track groups of stocks. Crypto trades digital assets. Commodities include things like gold, oil, and agricultural products. Each market has its own behavior. Some move slowly, some move violently. Some are active almost all day. Some are only at their best during specific sessions. Choosing a market is not just choosing what looks exciting. It is choosing the environment you will have to survive in. Forex means foreign exchange. In Forex, you trade currency pairs like ER/USD or BPP/USD. The first currency is the base currency. The second currency is the quote currency. If ER/USD rises, the euro is gaining value against the dollar. If EUR/USD falls, the euro is losing value against the dollar. Forex can be attractive because it is liquid and available for much of the week. But beginners still need to respect spreads, leverage, session timing, and news risk. Stock index markets represent baskets of stocks. For example, the NASDAQ 100 tracks a group of large non-financial companies listed on the NASDAQ exchange. The S&P 500 tracks a broader group of large United States companies. Index futures are popular with active traders because they are liquid, structured, and heavily watched. But they can also move fast. A beginner should not confuse popularity with safety. A market can be popular and still be dangerous when position size is too large. Crypto markets include assets like Bitcoin and Ethereum. They can move at all hours and often react strongly to sentiment, liquidity, and major news. Commodities include products like gold, crude oil, natural gas, wheat, and coffee. These markets can be affected by supply, demand, weather, geopolitics, inventory reports, and currency movement. The point is not that one market is better than another. The point is that each market has a personality, and you should learn that personality before risking real money. Different markets measure movement in different units. In Forex, traders usually talk about pips. In index futures, traders often talk about points and ticks. In Forex and some CFD products, traders also talk about lots. These words matter because they connect chart movement to money. A move that looks small on the chart can be meaningful if the instrument has a large dollar value per point or if the position size is too large. A pip is a common unit of movement in Forex. A point is a larger price movement used in many markets, including stock index futures. A tick is the minimum price movement an instrument can make. A lot is a position size in Forex. Lot size controls how much money each pip is worth. The beginner mistake is learning the word but not learning the dollar impact. Always ask, if this moves against me by 1 unit, how much money do I lose? This is why market units come before strategy. Two traders can take the same exact setup and have completely different outcomes because their position size is different. One trader takes a reasonable loss and moves on. Another trader takes the same entry with too much size and damages the account. The setup did not change. The risk changed. Before asking whether a strategy works, make sure you understand how the instrument converts price movement into profit and loss. Every market has a price where buyers are willing to buy and a price where sellers are willing to sell. The bid is the price buyers are offering. The ask is the price sellers are asking. The spread is the gap between them. When spreads are tight, entering and exiting is usually cheaper. When spreads widen, trading becomes more expensive and execution can become less predictable. The spread is not the only cost. Some products also charge commission. Commission is a direct fee for placing the trade. Slippage is different. Slippage happens when the price you receive is not the exact price you expected. This can happen during fast movement, low liquidity, or major news events. So the real cost of trading is not just the visible price. It is the spread, plus commission, plus the possibility of slippage. Markets do not behave the same way at every hour of the day. Forex traders often talk about the Asian session, the London session, and the New York session. Index traders pay close attention to the United States cash session, especially the open, the middle of the day, and the close. The same setup can behave differently depending on the session. Timing matters because liquidity, volatility, and participation change throughout the day. Liquidity means how easily trades can happen without price jumping around too much. Volatility means how much price is moving. High liquidity can make execution cleaner. High volatility can create opportunity, but it can also increase risk. Beginners often chase the most active moment because it feels exciting. A better approach is to learn when your chosen market moves cleanly, when it gets noisy, and when you should simply stay out. Order types are the instructions you give to the market. A market order says, "Get me in now at the best available price." A limit order says, "Only fill me at this price or better." A stop order says, "Trigger an order if price reaches a certain level." Order types are not just technical details. They affect execution, risk, and whether your trade behaves the way you expected. Two of the most important orders are the stop loss and the take profit. A stop loss is designed to close the trade if price moves against you. A take profit is designed to close the trade if price reaches your target. These orders do not guarantee perfect results, especially in fast markets, but they help define the plan before emotions take over. If you do not know where you're wrong, you do not have a trade plan yet. A broker gives you access to the market. A platform is the software you use to view charts, place orders, manage positions, and review trades. Sometimes the broker and platform feel like one product, but they are not the same thing. The broker controls account access, pricing, margin rules, and execution conditions. The platform controls the trading interface. Beginners should understand both before they deposit money. Margin and leverage allow a trader to control a larger position with less capital upfront. This is powerful, but it is also one of the fastest ways beginners get hurt. Leverage does not only increase opportunity, it increases the speed of losses. If a trader uses too much size, a normal market move can become an account-level problem. The goal is not to use the maximum buying power available. The goal is to use only the risk the plan can handle. A chart is a visual record of price over time. Each candle shows what happened during a specific period. It can show where price opened, where it closed, how high it went, and how low it went. But a chart does not tell the future. It gives context. The job of a trader is not to stare at candles and guess. The job is to build a plan around structure, risk, timing, and repeatable decisions. A beginner workflow can be simple. First, choose one market to study. Second, learn how that market measures movement. Third, understand the cost of entering and exiting. Fourth, decide how much you're willing to lose before you enter. Only after those steps should you focus on setups and indicators. If the foundation is weak, even a good strategy can be traded badly. Most beginner mistakes come from skipping the foundation. They trade too many markets at once. They use position sizes they do not understand. They ignore spread, commission, and slippage. They trade during news without knowing the risk. They enter before knowing where the trade is invalid. These mistakes are normal, but they are also avoidable. The purpose of this chapter is to remove confusion before it becomes expensive. Here's the chapter in one recap. Trading is decision-making under uncertainty. Markets are auctions between buyers and sellers. Different instruments have different behavior. Pips, points, ticks, and lots connect chart movement to money. Spread, commission, and slippage are real trade costs. Sessions affect liquidity and volatility. Orders, brokers, platforms, margin, and leverage all affect execution and risk. Once these foundations make sense, the next step is price action. Price action is where you begin studying how price moves, how structure forms, how trends and ranges behave, and how traders identify important levels. But price action only helps if the foundation is already clear. You cannot manage a setup properly if you do not understand the market, the instrument, the cost, the session, and the risk behind it. The goal of this chapter is not to make trading look easy. The goal is to make the basic language clear enough that the next lessons actually mean something. Learn one market. Learn how it moves. Learn what each movement is worth. Learn what it costs to participate. Then learn how to manage the risk. That is the foundation. In the next chapter, we begin price action with market structure.